Welcome everyone to the Microstructure Exchange. Happy to see you all here. Today we have Jason Su, who will present a paper on asset prices and investor behavior under randomized supply shocks. I can see at least two of the co-authors here, Mao Yi and Shidong Shao. The fourth co-author is Chen Yao. I don't know if Chen will tune in. Jason has said that questions are welcome throughout the talk, but there will be a couple of dedicated question breaks. And if you have clarification questions, you can type them in the chat where Mao will respond if possible. Okay. I think that's all. Jason, take it away.
Okay, so I'm gonna share my screen. Okay, so now it all looks good. So again, thank you again for Beyond for having this paper as a program. It's really a great pleasure. You know, I've been reading all the microstructure papers and know many names, and finally I have to see everybody here online. So title is called Asset Prices and Investor Behavior Under Randomized Supply Shocks. It's a joint work with Shidong and Chen there from CUHK and Mao from Cornell. I'm Jason, the third-year PhD student in Cornell. So the title may looks like kind of like demand-system asset pricing paper, which it does, but actually I'm going to show you microstructure can provide a very sharp intuition to this literature. And to me, the demand-system asset pricing and microstructure shares lots of similarity and intuitions. So let's get started. Over the past few years, there's a fast-growing literature in demand-system asset pricing. Started by the seminal work by Coding and Hugo, and which studies a wide range of questions. And one of the fundamental questions in this literature is to understand the slope of asset demand curve. And when I first read this paper, my intuition was that we've all studied Econ 101, and our intuition is that we should need an exogenous supply shock to identify the demand curve, the slope of demand curve. The great example is from the early IO literature, in which suppose you want to identify demand elasticity in the breakfast cereal market. You want to find the shock to the sugar or wheat prices, which are the ingredients to the breakfast cereal. And you can shift the supply curve exogenously and to identify the demand elasticity in the market. Surprisingly, however, so far the demand-system asset pricing literature assumes a fixed asset supply curve, and with this assumption, they try to do all the estimation. The assumption is kind of like understandable because we all know there is a market timing behavior by managers who tend to buy back shares when it's undervalued and issue shares when it's overvalued. So if you assume the fixed asset supply curve for your estimation, what you can do is that you rely on the demand side instrument for the estimation. And we can broadly divide the instrument into two groups. One is a time series. It includes the demand shocks. A great example is the Andrew Schleifer's early work on index inclusion events. Or you can find demand shifters approach, which is from the mutual fund flow. Suppose the mutual fund faces the unexpected inflow, they're gonna invest that additional money proportionally as before into the stocks and so on and so forth. The second instrument is from a cross-sectional variation, what we call the investment mandate approach that was developed by Coding and Hugo 2019's early work. So what's the intuition? So investment mandates, like you have to, like as an investor, you can only invest in certain type of stocks. For example, ESG funds can only invest in the green stocks, and the US university endowment can only invest in certain type of stocks. So the intuition is that if a stock is in more investors' investment mandates, then it's going to have lower residual supply and thereby higher prices. So with the cross-sectional variation in the prices, they can first estimate individual investors' demand, and then they can aggregate across all investors to get the aggregate demand curve, the elasticity of aggregate demand curve. However, those approaches don't come with no costs. I'm going to show you in one slide, but remember, this is one of the first cloud in the estimation. And the second cloud is sort of more intuitive, is that there is a complex spillover effects across all the assets. That really ties in the very basic intuition in finance, in which investors care about portfolio choice. They're assumed to have the mean variance preferences. So the demand of an asset not only depends on its own price, but depends on all the assets' prices. So if there's a demand or supply shock, it's going to propagate across all the stocks, and that really complex the estimation. So let me talk a little bit more about the sort of challenges in this literature when we assume there's a fixed asset supply. So one of the obvious intuition is that if you assume a fixed asset supply, the aggregate demand change is going to be zero. So there are two approaches. The first one is a demand shock approach, which basically look at the actual demand changes and which implicitly divides investor into two groups. The one is a shock investor and the other one is a unshock investors. And here the microstructure intuition can help. You can think of the shock investor as liquidity demanders. Think about the index fund. They want to buy the stocks that is included into the index. They are liquidity demanders. And all the other unshock investors, think of non-passive investors, are liquidity providers. They're going to sell the stocks to the index funds. So essentially, if you use the demand shocks, you're going to estimate the demand curve of the liquidity providers or the unshock investors. You may say, well, that's fine. We can still understand some investors' elasticity. However, there's a more recent paper by Zhiguo, Peter, and Jessica saying that no, you're still tend to underestimate the residual demand elasticity, or you're tend to underestimate the elasticity of liquidity providers. Why is that? The intuition is that under demand shock, the slope of those residual demand curve or the slope of liquidity providers is also going to change because they're facing a different risk exposure. Suppose I'm the investor, I'm in shock, I'm dumping all my stocks to everybody here in a Zoom, and every one of you is gonna have higher risk exposure in each stock because you are ended up with having more stocks. So you're gonna ask for a higher risk premium for that. And as a result, the equilibrium price reflects both the demand effects, the more stocks that lower the price, and the compensation for higher exposure. So if you simply run a regression, you're gonna sort of underestimate the residual, overestimate the price impact, and underestimate the elasticity. The second issue is sort of more intuitive, is that there's endogenous response by firms, which is that suppose the index fund is buying the stocks, then Zhongxing finds that the firm is going to issue more shares to offset this demand shock, the additional buyers. That will also bias the estimation if you assume a fixed non-response by the firms. And that's a challenge in the demand shock approach. The second approach is what I call demand shifter approach, which compared with the demand shock approach, the biggest difference is that it's care about the hypothetical demand changes under the assumption that if the price is fixed. And two challenges arise. The first one is that the normal model of demand system don't imply the demand shifter. You have to put more structure theoretically to provide the micro foundation to sort of shifters that only shift the demand parallelly but not changing the slope of the demand curve. And empirically, you have to justify and provide more evidence, which is kind of challenging, that investors respond to price changes in the same way as before. And the third approach is what we say the cross-sectional variation through the investment mandates by Coney and Hugo. It's actually a very innovative approach in the sense that we create the shock for every investor in the market, right? So as I mentioned, if you want to understand my demand elasticity, you're going to take everybody else in the market's investment mandates. And if a stock is in more investment mandates, they're going to have lower residual supply and higher prices. And empirically, Coney and Hugo measure the mandates by simply taking the holdings in the past 11 quarters. As long as they hold the stocks in the past 11 quarters, they're going to call it the stocks into the mandate, otherwise it's outside the mandate. However, the exogenous requirement is that what if a fund doesn't hold the stock due to the valuation instead of a mandate? Suppose the fund thinks that the stock is overvalued and it's not going to hold in the past 11 quarters. And then their manager is going to assign that stock outside the mandate, which kind of mismeasure the actual mandate. And that's going to create an endogeneity problem. And the second one is I would say, more severe is that Van Binsberger has a more recent paper saying that in order to ensure there's a unique equilibrium in the market, they have to truncate investors to ensure that everybody in the market has a downward sloping curve. And empirically, they have truncated around 40% of investors. So with such truncation bias on investors like momentum funds, think about that. They're the investors who want to buy the stocks more if the price is higher, right? They have the upward sloping demand curve. And if you truncate then, around 40% of them, that's gonna strongly bias the estimates. And that's the issue. So how can a microstructure help in the existence of so many challenges? So what we're trying to do in this paper is that we try to find a supply shock and with the control groups to identify the aggregate demand curve, and second, to understand what's the portfolio rebalancing behaviors across investors. The demand shock stems from a microstructure experiment in the 2016 Texas pilot, which many of you are very familiar with. There are many papers on this about studying the microstructure issues using this shock. But this paper is gonna take one step further, saying that it's an ideal setting to take it as a supply shock and understand the topic of demand system asset pricing. So the benefit of the supply shock is that all investors are affected. So we can really understand to identify the slope of aggregate demand curve. And more importantly, the firms are not having the mean variance preferences. They only have one, like their investment mandate is just singular. They can only invest in their own stocks. So if you want to relate our work to CUHK and Yoga, we really find a very exogenous investment mandate in the name in their concept of investment mandates. And we can also estimate the stock level price multiplier in one step, in the sense that we don't have to impose any of the structural assumptions. We don't have to truncate any of the investors' demand curve to get the correct estimates. And also, as I mentioned earlier, the second challenge is about the spillover effects. And luckily, the TSP provides a very ideal setting that allows us to control for the spillover effects through the control groups. I'm going to show later, but the benefit of the TSP is that it's an A-quarter shock and really allows us to relax some of the assumptions in the Valentin Haddad's paper about the causal inference as a pricing that address the spillover effects. And finally, and more importantly, the experiment allows us to check both the price and quantity changes in equilibrium. If you think about the demand shock approach, what they can do is they can just identify the slope of asset demand curve, and that's it. They cannot see how investors rebalance their portfolio in equilibrium because by default, holding changes is exogenous in the demand shock approach. And also, if you look at the CUHK and Yugo's demand system, they can only expand the cross-section of holdings, but not the changes or no time series changes on the rebalancing of portfolio holdings in the data because they're looking at cross-section variation. So that's a benefit of the supply shock and advantage of this paper. Okay, so why is the TSP provides an ideal setting of supply shocks? So the background is that in 2016, the SEC randomly selected 1,200 stocks to increase the tick size from 1 cent to 5 cents, and while another 1,200 stocks remains at 1 cent tick size. And surprisingly, we find that the treatment firms repurchased 20% less of their shares. And we're going to argue that it's really exogenous shock that surprises not only firms, but also regulators and the market. From a firm perspective, the small increase in tick size don't really affect their repurchase intentions. That was actually the early work by Mouse and his co-authors. And we further find that, and that's why we take one step further, is that the treatment and control firms announce a similar purchase program. And we do find that investors, like they experience a similar announcement cumulative abnormal return, which implies that investor view there's no information happening during the TSP in terms of share repurchases. And expose the mechanism of the supply shock is that there's an unexpected conflict between the regulations, the Rule 10b-18, and the TSP that yields a lower exposed fill rates of share repurchases. That is the main driver of the supply shocks. I'm gonna show you that intuition in the animation. I think that's more helpful. So here's the regular market. You have 1 cent tick size, and we can broader divide traders into high frequency traders and the firms, and we label the HFT as a rabbits. They're in general faster than the firms, and firms is turtle. Now, during share repurchases, firm usually has a very high valuation of their own shares. They want to execute immediately. They want to use the market orders. However, the SEC comes in saying that they're concerned about the price manipulation and saying that you better not buying at the market order. You can only buy at below or at or below the best bid. So basically, most of the time, firms cannot use the market orders. So firm has to use the limit order. So firm will join the queue with other traders and waiting for the execution of the orders. Why is firm slower than other traders most of the time? Because firm has to check out their algo to make sure that their execution complying with all the regulations set up by the 10b-18, right? And that's a normal time. And then the TSP comes in. What it does is that it removes 4 out of 5 price grid in the markets, right? They increase the tick size from 1 cent to 5 cents. And then what happens is that everybody is now joining and crowded in the same price level with longer queue, right? So with longer queue, basically firms are affected. They're experiencing a lower fill rate or lower completion rate of repurchases program because the execution follows the time priority. The longer the queue, the lower probability of the share repurchase, and that is the intuition of the supply shock. So it's been 15 minutes. Let me stop here to take questions from the audience. Any questions?
PK, go ahead.
Yeah, so one question I have is in terms of the choice for repurchases, right? You could do other methods of repurchase. Don't have to buy back. So if there's really a determined buyer, they could do the tender offers and so on, or they can even pay up. Like even there is a crowded, they can sometimes pay up. So it may still be endogenous choice, right? It's you're saying it's exogenous shock, but it should not necessarily stop determined repurchasers from executing, right? So I don't know how you deal separate. They can do it, but they won't do it at the tick size versus they really cannot do it, which should be fully exogenous.
Right, that's a very good question. So you're saying that why not firms choose other options to buy back their shares? In terms
Right.
of tender offers, it's very popular in the 90s and early 2000s, but it's now not very popular. The volume compared to the equity market buyback is tremendously small compared to the repurchases. And we also test if there's an increase or anything happening in tender offers, and we don't find any significant results compared between the treatment and control groups. But I think you're reaching out. You're talking about the question I'm gonna talk later is that firms can actually use the dog pools to avoid the equity market backbacks, and
Right.
we use
Yeah.
that additional to test the exogenous of the shocks. Yeah, I'm gonna show you in just a few slides, but
Got
that's
it.
very good
Okay,
question.
I'll wait
But
there.
in terms
Yeah.
of tender offers,
Thank you.
basically they're
Yeah.
not using. Yeah.
Mhm.
Okay.
Okay, Jason, I don't see any other questions, so let's
Okay, cool. So
continue.
I might continue. So we first do a standard diff-D regression, and we do find there is a significant decreases among treatment firms that they are buying back less shares. We find that the repurchases on treatment firms drop by 0.143% relative book equity, which is around 20% of pre-sample mean. And interestingly, we don't find any of the changes in equity issuance or dividend payouts, sort of validating the exogeneity of the shock because the regulation in the secondary market would not affect the issuance or dividends, would not affect the corporate decisions. And then we look at the newly announced share repurchase program during the TSP. So the procedure is that firm has to first announce how much share they're going to buy in the next year, and then they're going to execute in the market. So we don't find any significant changes in the newly announced repurchase program between treatment firms during the treatment and control firms during the TSP. I was suggesting that managers do not change their intentions of buying back any shares. So if they do realize something happening in the market, right? Suppose someone may argue that they may realize something's going on and there's a lower fill rate of repurchases. If that were true, they should have increased the announced volume to offset the adverse effects of the lower fill rate, right? But we didn't see that happening. And finally, we don't find any significant changes in terms of cumulative abnormal return around those repurchase announcements. That's not saying that we don't find any significant alpha. We do find some alpha during the announcement, but we find sort of similar alphas between treatment and the control firms around the announcement, suggests that investors themselves don't really expect the effect of TSP on share purchases, nor do they expect any valuation effects of the reduction or anything happening during the TSP on the future valuation of the stock. So having this nice shock, how can we motivate our empirical setting? So we start with a very standard 2-period Carrot normal model with heterogeneous belief, and it really relates to the Littner's early work. So some people think that demand system is a very new stuff. Actually, it's not. You can find it from a very early start of asset pricing. So every investor expects maximizing their next period wealth. And the gamma I is the risk reverse coefficient, and the intertemporal constraint is that next period wealth equals current wealth plus the return on their portfolio holdings. And every investor may have heterogeneous beliefs on the assets payoff in the future following normal distributions. So each investor will have the standard mean variance optimal portfolios. So here the sigma I inverse is the matrix, and mu I and P is the vector. We have n assets in the market. And market clearing condition is that you're summing over everyone's holdings and equals to total share supply. And that will give you an equilibrium price vector like this. So it equals the price multiplier matrix times sort of the average expected payoffs minus total share supply. And M is M by M price matrix. So, so what is the previous demand shock approach? Is that they try to find somebody who's being shocked in the market to identify the residual demand, the elasticity of the unshocked investor. So here's a simple example. There are two investors in the market. One is the blue investor, the other is the red investors. The aggregate demand curve is that at each price level, you sum over their demand. So the equilibrium price in the market is at 3. Now suppose the red investor leave the market. And now there's only one, the blue investor on the market, and the demand curve becomes this blue line, and the equilibrium price falls to the 1. So you have 2 points. You can identify the slope of the unshocked investors, the blue investor. That's the previous thoughts. However, there's a new paper by Zhiguo and his co-authors saying that no, it's not the case. What happened is that demand shocks, unshocked investors face a higher exposures when shocked investor leave. In this example, when red investor leave the market, the blue investors is holding more share and they're gonna have higher exposure in the future. So their demand curve actually shifts leftward. They have larger sort of price multiplier and lower demand elasticity to compensate for the future risk premium. So what you observe empirically is actually these 2 points. And if you simply run a regression, that will give you this biased red line tend to sort of overestimate the price multiplier or underestimate the demand elasticity of these green investors. And that's the issue of demand shock approach. So what is demand shifter approach? They focus on the hypothetical demand changes under the assumption that the price is fixed. So researchers try to find a demand shifter that shifts the demand curve parallelly from this equilibrium point here parallelly to this off equilibrium, and the price will adjust so that it reaches a new equilibrium point at P2. So the slope of the aggregate demand curve is just the P1 minus P2 over Z. But the challenge here is that it's very hard to find the demand shifter in a standard asset pricing model. You have to impose more structure and provide micro foundation to that. And the empirical challenge is that you have to justify that investors don't change their slope during the shifter. And think about the mutual fund flow. They may change their preference during the unexpected inflows of money. They're going to change the slope of demand curve. You have to justify that empirically. And also you have to correctly measure the Z, the demand shifter, because it really matters to identifying the slope of demand curve. Okay. So what is supply shock? So supply shock in comparison is surprisingly simple and straightforward. So what we need is that first the exogeneity, that the delta S is not a function of P, right? And then if you write out the new supply vector, it provides a very straightforward equation. It provides the one-step identification of the aggregate price multiplier, and we don't have to impose any of parametric restrictions on individual demands. We were all talking about aggregate demand. And nor do we need to distinguish the shock or unshocked investors, because all investors are affected during the supply shock. They all have to respond, right, to clear the market. And we can also clearly identify the shock assets because the firms can only invest in their own shares, and there's no issues about the measurement, like the investment mandate approach. The remaining problem, however, is the spillover effects. Here's the intuition. So if we dive into the big matrix of multiplier, it's going to have n by n terms, right? And the diagonal elements are the own price multipliers, the variable of interest. It tells you what if the total supply in the stock 1 changes affect the price of stock 1. However, there are many other cross price multipliers. Those are the off-diagonal elements of the big matrix. That tells you the substitution effects. What if the price in stock 1 changes in responding to a supply shock in stock N, and so on and so forth. So spillover effects is really the sum of a product of these off-diagonal elements times the correlated shocks. And this problem is sort of more severe in a TSP because everybody is being shocked. All the treatment stocks is being shocked. So pretty much in the same way, they are all reducing their share repurchases. So you have a very large second term here. If you don't control for that, then it bias the estimation of the own price multiplier, right? So we have to control for that. So how can we control for that? Well, we use that through the matching. Because we have ideal control stocks. So we match a treatment stock with a control stock N prime such that they're going to have the similar price spillover effects across any other stocks outside the pair, outside the match pair. So we can write out total price changes, the own price multiplier, times the spillover from the closest substitutions, plus the spillovers from any other stocks. And if we do the differences, we're going to eliminate all the huge third terms because they assume, we're going to verify empirically, they have a similar price spillover effects. So 1 minus 2 will give you these two terms equations, right? The first one is the supply shocks of the treatment stock, and second one is supply shock in the control stocks. So in early works by Zhiguan and Valentin, they start playing around with this equation. And it's assumed that they impose additional assumption that those two terms are constant. They assume a constant relative price multiplier. But in our setting, we can avoid this assumption because we know that the control stocks are not shocked. We know delta S and prime 0. So we can pretty much eliminate the second term and only keep the first term. And we can allow for a heterogeneous relative price multiplier across all treatment stocks. And that's basically the empirical setup, right? So how can we do that? So empirically, we first match the stocks based on their pre-shock characteristics. We match them based on the size, profitability, growth opportunities, repurchase payouts, and industries before TSP. And we show that they have identical observables after matching. And then we run the panel regression. Here, the delta S is the supply shock. It's the double differences between treatment and control before and after TSP. And the J indicates the match pair. So in each match pair, we only have two stocks, one treatment, one control. Delta P is defined similarly. It's pretty much you can think of as long-short portfolio return on each pair before and after the TSP. And we also control a bunch of fundamentals, especially liquidity, to further control any confounders that may affect the prices. And we also control for industry by time fixed effects to control the simultaneous industry level shocks. And here's the result. So in the first column, we report the estimation result without adding any controls. We find a price multiplier, the relative price multiplier of 2.01, saying that if there's a 1% decrease in repurchases in terms of book equity, it's going to produce a 1.01% drop in stock prices compared with the control stocks. And interestingly, the magnitude is identical if we add the liquidity controls or many other fundamental controls. If anything, we only get an increase in R squared. So it's just that the matching really capture most of the return differences driven by fundamentals, and the remaining variation is driven by the supply differences, is driven by the supply shocks. And then the second, going back to AK's early question, so anyway, there's liquidity effects. Right? Well, what if the price sort of response or changing is due to liquidity reasons? Luckily, we've got solutions, right? So the group 3 stocks in the TSP are further banned from using the dark pools during the TSP because the conflict of the trade-out rules and the 10B-18. So trade-out rules saying that if you want to execute your trades in the dark pools, you have to make sure that your execution price is at 2.5% cents higher than the highest independent bid. However, the 10B-18 says that you cannot do that. So de facto, the group 3 stocks are not allowed to buy back their shares in the dark pools. That creates additional drop in repurchase volume by 59% compared to group 1 and 2 stocks. And there's a kind of puzzle in previous literature by my co-author Chen's paper saying that the G3 stocks experienced a higher a higher price decline, but not a change in market liquidity, because the liquidity is more like a zero-sum game. If there's a bad liquidity in dark pools, the exchange liquidity is going to be better, but the overall liquidity is the same. So with the same liquidity condition, there's a additional drop in supply that allow us to test the hypothesis that the additional price drop in the G3 is driven by the additional drop in repurchases or supply shock. And if the demand curve doesn't change, we should observe a similar, the same price multiplier. Here's the result. We do a subsample analysis and we bootstrapped, do a t-test between the estimated coefficient between group 1 and 2 and group 3 stocks, and we found identical results. They all have around 2% relative price multiplier. So the larger decline in price of G3 stocks is primarily driven by the decline in share repurchases or supply shocks, right? And it's now 11:30. I may pause here to see if people have questions. Okay, Gideon.
You went over it pretty fast, but let's see if I understand something. The cross terms in that big matrix, you assume that you can drop all of them except for the matched control stocks.
Yes.
That assumes that all of the stocks that are treated experience the same shock. But we know that depending on the price level, right, the 5 cents, for example, if the price level was very high, so the natural spread was 25 cents, 50 cents, it will be much less binding, right, to have a 5-cent tick size. So how can you correct or fix that?
Right. So in this structure, we don't impose any restrictions on the amount of the shares they buy back from market. Here, the delta SM is really the supply shock coming from all the other treatment firms, and the delta SM is really the free parameters. We don't impose any of them. It could be anything. So linearly we can express that price changes due to the supply shocks in the treatment firm N. By first term is its own supply shock. The second term is a supply shock in closely substitute. That is the control shock, which is 0. So 0 in second term, and many other supply shock from the treatment firms. That is the sort of the third term we want to eliminate. No, so we don't impose any restrictions on delta SM. It could be anything.
Thank you.
Yeah. So the key is like the comparison is within a pair, the treatment versus the control. We do not control across different treatment stocks.
That's true. Thanks, Mo.
Right, and the price has to be the same between the treated and control.
No, it doesn't have to. I mean,
but
the delta
isn't that the key of how of whether the treated and control would face the same or not? Would it kind of the counterfactual, right? Or am I missing something here?
Right, so here is the double differences in search. So delta P here is a return before and after TSP, and we're taking the return differences between treatment and control firms. I understand your concern is that what if the control firms are buying back their shares due to the during the TSP, and that's gonna being taken out by the differences, because we're essentially taking out the sort of the average by taking out the pre-shock mean, and the delta P is the return driven purely by the supply shocks. Yeah.
Thank you.
Yeah, I think Ian raised a great point. We should also match on price between the treatment and control
price
group.
is not because price is not stationary. You can't really do that in the matching, but we do match.
I mean, compare the matching pairs when we match the stock.
Yeah, maybe, but we have matched on repurchase payout, so I don't think that really matters. All right, price is just nominal. Anyway, so let me proceed. So we have estimated the relative price multiplier is defined by the own price multiplier minus annoying cross term, the cross multiplier. And maybe we're interested in the own price multiplier. We're interested in not just the relative performance of price. We're just interested in what if the price supply of stock 1 changes, and then what's the price response of stock 1 itself. And then we derived a sufficient condition such that the estimated relative price multiplier is going to approximate the own price multiplier, and we empirically test this condition. What we do, we just impose one factor structure following Coding's later work. by assuming that the future payoff follows sort of the one-factor structure, the expected payoff plus one-factor exposure plus some idiosyncratic shock. We can also extend it to multi-factor model, but intuition will remain the same. And here's the proposition. Suppose within a matched stock pair, if they have similar factor exposure, and if the factor exposure risk, the beta risk, is way smaller than the idiosyncratic risk, then first they're going to have similar spillover effects, a similar cross multiplier compared to all other stocks. And then the estimated relative price multiplier is going to approximate the own price multiplier. So if you think of the CAPM case, the own price multiplier is just the idiosyncratic risk plus the beta risk. And the cross multiplier is the product of two stocks' beta risk. The relative is the idiosyncratic risk in stock N plus the beta risk times the difference is the beta risk within the matched pair. So if they're having a similar beta risk, the second is going to drop out and only the first term matters. And if the first term is way larger than the second term, we can say that the M relative price multiplier approximates the own price multiplier. That's the intuition. So empirically, we first bundle the treatment and control firms and do a long short portfolio and regress that onto a market return, one factor. And we plot the beta coefficient here, the point estimate and the t-stat. So most of the periods during the TSP, the beta is around 0, saying that the treatment and control stocks are moving together. They have a co-movement. So they have sort of a similar spillover effect with all the other stocks. And then we calculate the idiosyncratic risk and the beta risk following standard literature. Within every month we run a daily regression, a daily return on the market return. And the idiosyncratic risk is the variance of the error terms, and the beta risk is just the beta times the variance of the risk factor. And summary statistics show that the idiosyncratic risk is 6.7 times larger than market risk exposure on average. We also do a t-test, more distributional tests. And we can say that, the null hypothesis is that the beta risk is larger than the idiosyncratic risk at the C level. And we can strongly reject this null hypothesis at 1% level in a threshold of 7.9%, which is saying that the beta risk is less than 7.9% of idiosyncratic risk. So empirically, yes, idiosyncratic risk is very small compared to the beta risk, which is also consistent with previous literature on idiosyncratic risk. So if you accept the additional assumption of the factor structure of future payoff, we can say that our estimated 2.01% relative price multiplier approximates the true own price multiplier. Okay, and the last part of this paper is really to care about the investor response to the supply shocks, which is another very interesting question. A Cohen and Hugo study, as I mentioned earlier, the level or the cross-sectional holdings of the investors, because they're using a cross-sectional variation instrument. And there's some works on bond market studying the changing of investor holdings under a concept of QE, but only in a bond market. And there's no study in stock market, how does investor respond and adjust their portfolio in equilibrium. Why is that interesting? So if you write out the changes in their holdings in equilibrium, that's gonna governed by this absorption matrix. What is absorption matrix? It's a product of their elasticity matrix times the price multiplier matrix. So what's the intuition? So the supply shock gonna move the price first through the price multiplier matrix, and then given the price changes, investors gonna adjust their holdings through their price multiplier through their elasticity matrix. So the intuition is that given the price change, more elastic investors tend to adjust more of their holdings. And that's really another aspect to see the equilibrium in the market. Okay, so how can we do that? So we run another panel regression. The delta Q here is defined as the quantity changes between treatment and control stocks before and after the shocks, right? Pretty much the same as we define the supply shock. And here we are focusing on the investment type I, and within each pair stock. So within each pair stock, there's one treatment and one control stocks, right? So we regress their holding changes, the double differences in holding changes, onto the supply shock we just constructed. And we also control a bunch of control variables, fundamental liquidity, and fixed industry time fixed effects. So the key coefficient here is the beta I that tells you the holding changes, the relative holding changes of investor type I when facing a supply shock. And we follow the same taxonomy of Cody and Hugo. We're looking into the institutional holding data in 13F, and we divide investor into banks, insurance, investment advisors, mostly hedge funds, mutual funds, pension funds, all of small funds, and household. And here's the results. What do we find? We find first that when treatment firms increase one additional share supply, right? When the household is gonna purchase one shares more, and investment advisor is gonna repurchase 0.452 shares more. So the households and investment advisors, mostly hedge funds, are really absorbers of the supply shocks in the market. On the other hand, the other small funds going to sell additional 0.189 shares to the market. So they kind of like exaggerate the supply shock by selling more shares to the market. So if you believe that during the supply shock, if they repurchase that, the additional supply shock, the price going to drop during the time, then the other fund is acting like momentum funds, right? The lower the price, the lower the holdings. So that's basically the findings. So I'm pretty much done. So let me conclude, and we can take a question. So this paper is really, I would say, the first paper in equity market to estimate the stock level price multiplier using exogenous supply shocks, and that's how the microstructure can help to construct a supply shock from a tick size pilot. It's a randomized exogenous to firms and market participations. And we use the price change in unshock control stocks in the TSP to eliminate the spillover effects among stocks. And compared with the demand-based approach, supply shocks is not just finding another estimate, but it's really important and necessary because we can first clearly identify the shock investor and affect the assets, and we can provide an unbiased estimate of stock level price multiplier in one step without truncating elasticity of the individual investors or impose any structural restrictions. Nor are we concerned about the sort of endogenous risk shifting, demand shock approach, if you can remember the Chigwa's paper. And empirically find the price multiplier of 2.01, and that's very robust after controlling liquidity and fundamentals. And we can argue that that estimates approximates the own price multiplier, given the assumption of factor structure, and empirically we verify that as long as the idiosyncratic risk is smaller than the exposure to systemic risk, then our estimate approximates the own price multiplier. And finally, we find that household and mostly hedge funds absorb most of the supply shocks, and other small funds just exaggerate the supply shocks. I'm pretty much done, and thank you very much. I'm looking forward to take questions.
Thank you, Jason. Very nice presentation. We have a question from Chester. Do you want to take it in voice, Chester?
Sure. So the a question I just posed a moment ago was, should we be concerned about spillover effects in this context? That is, it's not just that there's some stocks which are where the tick is adjusted and some stocks not, but the overall market has this experiment in place.
Yeah, exactly. So that's gonna. So let me go back to the previous equation. So technically, I mean, theoretically, you can write the third term, not just including the treatment firms, but all the other firms that have the supply shock or any changing in supply. You can, so the N would not sum up to N, but all the stocks in the market. But as long as we match the stocks within the pair, we're taking the differences, that's going to be eliminated, right? Because they have the similar spillover effects. So here, the control store really plays an important role. They're going to help eliminate most of the spillover effects, either market-wise or within the treatment firms. And also empirically, we further control for industry time fixed effects that sort of capture the market-wide movement and industry level common move that can really further address the concern. Yeah. Yes.
Are there any other questions?
Yeah, I can see many in the comments.
Can't see any questions at the moment. So while waiting for questions, let me announce that in 2 weeks we have Amit Goyal from Lausanne coming to the Microstructure Exchange. So hope to see you again then. And if there are no further questions, I will thank Jason and co-authors a lot for coming today to give this very interesting talk.
Yeah, thank you, Bjorn, for hosting this
Thank
great
you.
event.